Good afternoon, ladies and gentlemen. It's 1 o'clock exactly. So, in the interest of a prompt start, we'll begin because I'm sure you probably want to watch the golf or something this afternoon from Minnesota. So, hello, I'm Ross Mould, and welcome to our Brexit 3 months on webinar. We last spoke about a week before the EU referendum vote, so we thought it would be timely to have a look at the world and how financial markets have changed and what they're thinking now, 3 months after that decisive vote. I'm going to run through a presentation for about 15, 20 minutes tops, and then go through any questions that you may have. Now, you can submit questions at any time during the presentation. Just click on the question mark button on the left hand of the screen. So you don't need to wait until the end if I say something halfway through that you think is interesting. Only the moderator will see the question, so don't panic if it disappears after you've submitted it. And we promise not to reveal your name or identity if you're feeling shy. So please, there's no need to be embarrassed. If you have any technical problems, please just use the chat function till there's no, and you can access that by clicking on the chat symbol on the left-hand side. It looks like two little bubbles. So let's get started, and I hope you enjoy the webinar. So here's the opening slide: investing in a post-Brexit world. Some fairly prominent faces who've come to the fore in the past 3 months, and then that little insect at the bottom, the cockroach. We'll be talking about him or her, I suppose, right at the end. So these are all important risk warnings. I'll just let you digest those for a few seconds. I know that you're used to seeing these things now, but they are extremely important. Some key findings there, some key issues there, obviously about past performance not being a guide to the future. Always think about tax, always contemplate risk, and do remember, as we all know, that things can unfortunately go down as well as they can go up. So let's quickly look at the contents. What's the market thinking now? Themes to watch going forward, potential end games and conclusions. So what have we seen in the market since the 23rd of June? Well, remarkably, given all of the given the unexpected nature of the Brexit referendum result, at least as far as the stock market and the opinion polls were concerned, it's actually been quite hard to lose money in the subsequent 3 months. Pretty much most things you can think of have gone up. The exceptions, of course, are the UK pound, sterling, and for that matter, UK interest rates. And as a result of that, from an investment point of view, in this 3 month period, and I admit it's a very short period of time over what is a very long term exercise, which is investment, overseas was a good place to be, because as the pound went down, the value of any overseas holdings automatically went up, assuming, of course, their share prices remained the same. In the UK, we've seen a spectacular rally. I was actually on Radio 5 Live that morning with Adam Parsons on Wake Up to Money, looking at the UK market open down around 10%. And by the time the broadcast had finished 2 hours later, it was down 3 or 4%, and it finished the day down not too much at all. But we've seen a clear trend since then. That initial volatility, dollar earners and exporters have led the way. Small caps and large caps have led the way, with domestic players and to a degree small and mid caps lagging. Globally, emerging stock markets have done the best, possibly because they seem to be a bit of a Brexit haven, possibly because they've been absolute horrors for the previous 3 or 4 years, and therefore potentially because somebody somewhere felt there was some value sneaking out. But don't forget that although I've just focused on equities there, bonds have actually done very well as well. Now, I know there's been a bit of a wobble there in September, but overall bonds have still generated positive returns in total sense, i.e. coupon plus capital gain, as the ongoing scramble for yield continues. Remember, we've seen the Bank of England cut interest rates. We've seen the Bank of Japan further extend or tinker with its negative interest rate and quantitative easing program. We've seen the US Federal Reserve sit on its hands yet again and not raise rates. So we're still looking at this potentially lower for longer environment as regards rates, and therefore cash returns, and therefore bond yields. And that has again put a premium on income for those who want it. And so bonds have not done badly in the past 3 months either. And as I've just suggested there, central banks have remained key players and are likely to remain so, though it's equally clear that there is now a drumbeat gathering, and you can pick it up in the Financial Times newspaper every day. More and more people are questioning whether we're coming to the end of the powers of monetary policy as we reach the zero bound in interest rates, and whether there is now a supplement to monetary policy needed in the form of fiscal policy. So I've mentioned the pound, and this is in a strictly UK context, but this helps to explain why certain sectors have done what they've done. It's courtesy of our good friends at Shares Magazine, and it just looks at which sectors have got the biggest overseas exposure and the biggest domestic exposure both in terms of their revenues and their cost base. And as you can see, it's really over on the left hand side where the where the winners have been, those with very high overseas asset percentage of overseas assets or revenues or profits that are just automatically worth more once they're translated back into sterling. And the general losers have been on the right hand side, those with very limited overseas exposure, or worse, their overseas exposure has been in their raw material and input costs. General retailers and food retailers are a classic example here. We've all heard Next complain about the fact that its raw material costs will go up on a blended average by around 5% next year. So the company now has to decide, does it chew on that and take the margin hit, or does it try and push prices up, which in the current environment may be rather tricky to do. So that's a very simple graphic, but it does sort of help summarize how the UK stock market's been thinking over the last 3 months since the Brexit vote. The question is, will it last? This is the pound in the 1990s. We all remember, or a lot of us remember, 1992, when sterling was ejected from the exchange rate mechanism and its peg to the then Deutschmark was broken. This shows sterling against the ECU at the time, and you can see that big drop in 1992, which was very dramatic at the time. But equally, you can see that the pound within 2 years had actually recaptured most of that lost territory as the UK economy accelerated. The Bank of England began to actually jack up interest rates and give investors a reason, yield-wise, to put their cash and faith back in sterling. So if the pound does start, if the UK economy export wise begins to get some traction, it's possible you could see a repeat again, even if, as we know, the past is no guarantee for the future. But there's certainly just relying on sterling weakness probably isn't much of a policy from an investment perspective, or indeed an economic one. Even if Governor Carney of the Bank of England is clearly quite happy to sacrifice sterling under normal circumstances, when the pound went down, the Bank of England would have raised interest rates to protect it. Not so this time around. So let's just look at what we've seen in past similar situations. Well, on the left-hand column, this is just looking at the FTSE All Shares 39 constituent sectors and how they performed in the 12 months after the pound fell out of the ERM. Lots of dollar earners and cyclical sectors in there, like industrial metals, technology, hardware, forestry and paper, and aerospace and defense. And then on the right hand side, what I've done is I've just looked at which sectors did best after the Bank of England launched QE1, QE2, and QE3 and taken the average. And again, very similar type of stocks, all because they're big overseas earners, they're big potential beneficiaries of sustained sterling weakness. So those are the stocks that have historically done well in that scenario. And lo and behold, again, we've got a weak sterling scenario now, and lots of similar sectors are in the vanguard as we speak. And just looking at the top and bottom 10 FTSE 100 performers, over the last 12 months, again, this trend comes out pretty clearly. Metals, dollar earners, generally predominating on the left. Micro Focus is a big dollar earning software company. And on the right hand side, it's been the domestic players who've generally come off worst. Next, Marks and Spencers, and some of the builders. So that is largely, in a microcosm, what the market's been thinking for the last 3 months. Overseas good because of the weak pound, domestic bad because people don't know what it's going to mean for the UK economy, and it can potentially increase raw material costs for domestic players. And even over the last 3 months, basically since the vote, very similar trends, miners at the top, and on the right hand side, domestics on the bottom. But it has just begun to shift, and that's partly because, let's face it, we've seen some very, very dramatic share price movements, and ultimately it's valuation that will determine your return from a stock. We can all spot a good story, we can all spot a good management team, but it's the price that you pay for that stock will ultimately decide. And as you can just see here, one or two domestic players like Barrett and Persimmon have sneaked into the left hand side because the housing numbers have held up, their earnings have held up, their dividend yield still looks safe. And on the right hand side, one or two of the dollar earning resource stocks like Randgold have just begun to dribble into the bottom section, and Pearson, a big dollar earner, that's been hammered because of fears over the weak US academic textbook market. So the picture is becoming a little bit more nuanced now because share prices have moved so much. You've got some contrarians looking to see if could sniff out domestic value, or is it time to knock out some of those exporters and dollar earners who've maybe got a bit expensive? So it'll be interesting to see over the next 3 to 6 months if the market begins to reassess. And a lot of that will be driven by economic data. In the end, of course, we haven't had Brexit yet. We haven't had Article 50 invoked. So all the market's responding to right now is sterling the pound going down, and the fact that economic statistics initially wobbled in July, then generally rallied in August. We've got a big rash of purchasing managers index surveys next week. So let's see how the economic statistics look going forwards, because that's going to be a big dictator. And I used this chart when we did the event back, the equivalent webinar back in June before the referendum vote. This just shows again the wise owl economists, all part of a report prepared for Neil Woodford's investment management team by Capital Economics. It's a totally independent report. They just gathered all of the major surveys on what people thought Brexit would mean, and as you can see, nobody knows. We've got some economists on the left hand side talking about it could hit UK GDP by 10%, actually knock it down. You've got some economists on the right hand side saying it's going to boost GDP by 10%. So in the end, nobody knows. As I've said before, we haven't had Article 50 invoked yet. We don't know whether it's going to be a hard Brexit or a soft Brexit. We don't know what trade negotiations are going to take place, what the relationship's going to be with the EU going forward. So at the moment, it's in some ways hard to tell. This isn't in some ways a post-Brexit webinar, because we haven't had Brexit, but what it is going through is what we've seen so far, which is mainly pound weakness, economic statistics wobble, and then bounce back. So, what are the themes going forward that I think we should be looking for? Well, clearly, we need to be expecting central banks to be very active, even if, again, there's this drumbeat narrative that people are questioning whether monetary policy has worked or is going to work going forwards. And in fairness, Governor Carney of the Bank of England, Signor Draghi at the European Central Bank have both said publicly monetary policy cannot do everything on its own. They are now calling out for fiscal stimulus, a view that's shared by Justin Trudeau of Canada, Jack Lew, the US Treasury Secretary, Matteo Renzi of Italy, Shinzo Abe of Japan. There is a gathering call for fiscal stimulus. Now, where's the money going to come from, given that governments are generally skint? That's a question that we still need to address. Theresa May, the British Prime Minister, has talked about infrastructure bonds, for example. Let's see what Chancellor Philip Hammond comes up with in either the autumn statement in late November or the budget next March. But there is clearly talk of more needs to be done to get growth going. And just the very fact that we're having this debate 7 years after interest rates went to rock bottom, QE was launched, is in itself perhaps a clue that monetary policy isn't the only solution, might not be the only tool, and it perhaps isn't bringing the strong growth that everybody wanted. Now, we've also got some political issues coming up. Straight after the UK referendum result in June, Geert Wilders in the Netherlands, Marine Le Pen in France immediately called for French and Dutch referenda on whether France and Holland should be members of the EU. EU authorities ignored them completely, but clearly the UK result has given hope to those parties who do not believe in the European project, who believe that it's gone too far. It's no longer just an economic union, but a political union, and one that they feel will, in their view, do more good than harm. And we do have, very tellingly, 4 big European ballots coming up. Italy in December, we've got Italicum. Now, that's on Italian constitutional reform. It's got nothing to do with the EU at all. But Italian Prime Minister Matteo Renzi's potentially been a bit of a dummy, because he said if he loses that vote, he will quit. And he is profoundly, clearly Europhile. The opposition party, the Movimento Cinque Stelle, the MSM, under ex-comedian Beppe Grillo, is avowedly anti-EU. If Renzi falls, Italy could swing towards an anti-EU party, and that would have all sorts of political implications, particularly ahead of the German, French, and Dutch elections in 17. I've talked about Le Pen and Wilders in France and Holland. You've got the Alternative für Deutschland and Frauke Petry in Germany. That's been making huge gains at the local level. 3 very big elections could definitely create short-term volatility, though, as I always stress when I talk about politics, politicians think in 4 or 5 year cycles, because that's a bum on a seat as far as they're concerned. Remember that a long term bond or an equity is a 10, 20, 30, 40-year investment. So, yes, there'll be short term volatility, but in the end, you still need to look at a stock, its management, its competitive position, its balance sheet, and its cash flow, because that's what's going to really dictate valuation and therefore price performance. And even a politician's very short spell in office might not be able to make a profound difference to that in the end. But nevertheless, We've got some interesting times coming up economically. We're going to wait to see what comes out of the UK as we get nearer the end of the year. We're going to see what Article 50 actually leads to. Well, when it's invoked, what Article 50 then leads to in terms of trade agreements. And don't forget, one of the French presidential candidates, Nicolas Sarkozy, he's already saying if he wins next May, which may look a bit of a long shot because he hasn't got his party's approval yet, on the 7th of May, on the 8th of May, he'd fly to Berlin to come up with a new EU treaty. On the 9th of May, he'd come to the UK and say, look, here's a new treaty. We're going to cut you a deal. Now you can decide again whether you're in or you're out. So already the Europeans are starting to ask themselves, do we need to cut Britain a deal? Now, not everybody's going down that path. Merkel isn't, for example. Jean-Claude Juncker doesn't seem that keen. Even Mr. Draghi doesn't seem that keen. But you just never know when push comes to shove, again, depending on these election results. So there is certainly scope for further political upset. Economically, we're still waiting to find out. So what are the potential end games long run? Well, the overweening theme of low interest rates, low growth is still with us, and we're still struggling with these two potential long-term financial end games. Do we get the bugbear, the demon, deflation? There are some very strong deflationary forces out there. Debt is deflationary because the interest payments suck away money. A strong dollar is deflationary because it makes commodities more expensive. Demographics are deflationary. We get older, we tend to need less, we tend to spend less to make sure we run out before the money does. And also, the internet is massively deflationary because it creates price transparency and means that there's nowhere to hide for anybody. So it does have a price crushing tendency. If you believe that the world is still going to be sucked into a deflationary spiral, as Japan has been for the last 25 years, historically, bonds, sovereign bonds, government bonds, cash, and income generating equities have been the place to be. But central banks don't want the scenario on the left because deflation makes debt more expensive to service, and that would probably tip us over the edge into a very, very deep and profound recession. Central banks therefore want inflation because that erodes the value of the debt, pays it back in real terms, or it decreases its value in real terms. And that's why they're still got interest rates where they are. It's why the Bank of Japan and the European Central Bank and now the Bank of England are electronically creating money again with QE. They want inflation, and I don't think they'll rest until they get it, even if that means corralling the fiscal authorities into fiscal stimulus. Now, if you get monetary stimulus plus fiscal stimulus, maybe, just maybe, you start to get the growth we've all been needing. Maybe inflation starts to pick up. And if that's the case, historically, and again, past is no guarantee for the future, growth and cyclical equities, junk bonds, and gold are where you've needed to be. Two diametrically opposing problems, two diametrically opposing solutions. So portfolio creation, building a balanced portfolio is important because, again, as I suggested with that crystal ball, nobody knows. The economists don't know. Stock market analysts don't know. I'm going to be honest enough and say I don't know. Fund managers don't know. We can all have an educated guess. We can all look at what we think is priced into assets and what isn't. But in the end, none of us know. And how do you deal with that? Well, this is only one idea that somebody's come up with, and it's by no means a recommendation or a prescriptive piece of advice. By no means. This was devised by a strategist called Dylan Grice at the French investment bank Societe Generale, and he wanted to build a portfolio that was designed to kind of meet any weathers: deflation, inflation, stagflation, boom, bust, you name it. And he built this portfolio. I've started it off in 1990, assuming a current full ISA contribution of just over 15 grand. As you can see, it's not done bad. And it's a four-pot portfolio, equally weighted, rebalanced once a year. A quarter gold, a quarter cash, a quarter bonds, and a quarter high-yielding equities. Now, clearly, any one time, one of those is going to do badly. At any one time, you'd like to think one of them will be doing well. A couple in the middle will be doing okay. At the moment, cash is an uncomfortable place to be. At the moment, bonds are an uncomfortable place to be, particularly if you think inflation's coming because the yields are incredibly low. Gold, lots of people don't like it because it's inert and useless and is a sort of hedge on global fear. High yielding equities is where most people tend to feel comfortable. So if one of them's going to go wrong on the balance, that's probably the one that'll go wrong first, but you never know. But nevertheless, that's the discipline. It makes you do things that you don't like, and the rewards generally haven't been too bad. As you can see here, just 2 down years in 25. So that's Grice's answer to the no crystal ball conundrum, because none of us have got one. Portfolios still need to be prepared for a range of eventualities because we just don't know what's going to happen. Brexit hasn't happened yet. What we can see is that sterling's suffering at the minute. But if Europe starts to go down the Wilders Le Pen Alternative für Deutschland route, who knows, the euro may be the next sacrificial lamb and sterling starts to rally. So you still need to look at companies, or you'll need to look at funds that look at companies that really home in on company fundamentals. And there are still other factors here. In the end, it's down to profits and cash flow. They're the ultimate arbiters of your long term returns, and lots of fund managers will focus on that for you. And as we all know, if in doubt, do nout is a pretty good strategy, because then it means you're not incurring unnecessary trading expenses, commissions, and potentially taxes. And in a low growth, potentially low return environment, keeping your costs low and not paying out too much in commission and fees is a terrific way of boosting your long run returns, or at least not eroding them. So that's a whirlwind tour in 20 minutes flat. I can see a few questions starting to dribble in here. But if you've got any questions, I would now be absolutely delighted to answer them. So I'm just going to have a very quick look down the right hand side and see what I've got here. Here we go. Which shares are safe to invest in this scenario? Well, again, that comes back to the crystal ball problem. Unfortunately, I just don't know. Again, if you're a, if you're a, if you're a if you really believe central banks are going to succeed and that inflation's going to kick off, then certainly equities with which you're still looking at pricing power companies, but you'd actually almost find yourself lured towards some pretty risky cyclical stocks with indebted balance sheets, because the inflation will erode their debt. There might be an economic kicker, and then almost what you're seeing is you might see the market flip around where we've been in the last 3 months. The quality growth trade would look tired. The expensive defensives like Diageo or SEB Miller or Unilever or Reckitt would look tired. And under that scenario, the market would start to perhaps latch onto the depressed house builders and cyclicals in a pro-inflation scenario. In a pro-deflation scenario, you'd probably see more of the same of what we've had recently. So people would stick to what then they would think would be a safer scenario of the quality defensives, the tobacco, the drinks, to a lesser degree the food producers, guaranteed consumer staples. So again, the concept of safety will depend on what scenario we're looking at. But in the end, the lower the valuation you pay for a stock, the safer it is. And we've seen that, some very big, well-known stocks. Capita was an example this week, have taken a real hammering. As soon as there's an earnings disappointment, a stock's going to get hit hard. Associated British Foods did nothing wrong with its quarterly numbers, but the stock went down 10% because it was on a 28 times forward rating, twice the market multiple. So if you're looking for safety, try and pay relatively low valuations as best you can. Don't get sucked into paying very high ones unless you're utterly convinced the momentum is there, because there'll be a high penalty pay if that momentum slows down. But which stock is safe will depend upon which economic scenario we ultimately get. I don't know what that's going to be, so you probably need a mix and match policy. Now, next question. Sector. There we go. What sector can we best invest in to predict against potential downside and get some upside? Same answer. It's which scenario to believe in. And I think if I was forced to guess, I think we'll get a deflationary shock first, followed by inflation second, when central banks really open up the cannons and fiscal stimulus really begins. So again, but I don't know when that shift's going to come. And I could be wrong. At the moment, the market's looking a little bit more inflationary in its outlook than deflationary. I think the banking worries we've got with Deutsche Bank might stuff that out. But again, if you think deflation, you're looking for consumer defensive staples, maybe there's some of the druggies. If you think inflation, you're looking for cyclicals, you're looking for builders, you're looking for domestic players. So again, it depends on which scenario you want. You probably need a little bit of mix and match of both, because we just don't know what's going to happen. But it will all depend on that long-term scenario. A debt crisis in China. That one's gone away. And it's a really interesting question, because, I mean, in the end, Chinese debt to GDP is now 255%, according to the Bank of International Settlements. That's not sustainable. We've no real insight into the shadow banking system. We do know that China has primed the pump this year fiscally and with monetary stimulus. So again, that's why people are looking, well, if China can keep growth bombing along at 7%, with this mixture, can we get something going? I think there has to be a reckoning one day. I think if you talk to Asian fund managers, and I've actually met a few just this week, they're relatively happy with Asia. They're less happy with China. And what they certainly don't do is invest in Chinese state-owned enterprises that are incredibly heavily indebted. What they will do is look at new Chinese-style companies, the internet companies, the social media companies like Baidu, Tencent, and Alibaba. Again, you've got to be careful of the valuations there. Let the pros get on with it. But I think a Chinese debt crisis, if there's a sleeper story in 17 that's going to sneak back up on everybody, that will be my guess. Don't forget the Chinese currency, the renminbi, is still sneaking down. China's currency goes into the International Monetary Fund special drawing rights tomorrow. So China is continuing to flex and open up its markets very gently. But yes, Chinese debt is still an issue. It's not gone away. And that's why I wouldn't want to get too carried away at the moment by the current commodity price rally, because China's still probably the biggest net buyer at the margin. Gold and silver at 5% in a portfolio. Well, the cockroach runs at 25 and then rebalances once a year. That clearly isn't for everybody. That's a high risk strategy. They're both very, very volatile, although it's a high risk strategy that has been proven to be balanced out by gold, bonds, and equities over time. If you're going to invest in gold and silver, there are lots of ways to do it. The physical materials, stick them in a safe, but then you have to pay insurance. You can do it through exchange traded funds. You can do it through individual equities, or you can do it through funds that are dedicated to these areas. I think in the end, looking at some of the individual stocks or the funds, at least you get the benefit of a dividend yield out of some of them. So that's probably one way of cushioning yourself on the downside if gold and silver roll over, for example. But I think, to be fair, they are a good bit of ballast for a portfolio to prepare for the worst case of a major loss of confidence, or indeed central banks overdoing it on the inflationary upside. So long as you're prepared to accept the price volatility, don't find yourself having to liquidate in an inconvenient time. It's definitely an option, and it's one that the cockroach portfolio suggests over a long period of time will bring benefits, even allowing for short-term volatility. Can we distribute the slides? I can see no reason why not. We will be delighted to do so. You can find me on Twitter or send me an email at russ.mould@ajbell.co.uk, and we'll make sure that they get sent out. Can I summarize the cockroach again? Yes, with pleasure. It's a 4-pot portfolio, equally weighted, rebalanced once a year. Gold, now you can do that again in the different options I've just explained, either physical, and I've just used physical gold price for that particular portion, or miners or ETFs or funds. Cash, bonds, generally government bonds. There are some great government bond funds out there, but don't forget you can buy government bonds yourself through the post office if you want to, or through platforms such as ours, or indeed through the London Stock Exchange. And then high yielding equities. For that cockroach calculation, just as to give you an example, all I did, and this isn't a recommendation, I just used Mark Barnett's Invesco Perpetual UK Equity Income Fund, and I chose that because its current dividend yield is exactly the same as that of the UK market. So I wasn't trying to make any particularly heroic assumptions, although I must declare Mark Barnett is actually a shareholder in one of his funds in AJ Bell, by the way. He's just a very well respected fund manager with a good long-term performance record, and his dividend yield is currently pretty much where the market is. So it's those 4 pots rebalanced. Why those 4 pots? Gold is a hedge against inflation. Cash is a hedge against deflation. Bonds is a hedge against deflation. Equities is a hedge against inflation. So you're sort of preparing yourself for any eventuality. And through equities and cash and bonds, there's a bit of income coming in. Gold is a bit of a hedge against everything going wrong, if the truth be told, as well as inflation. If fiscal policy QE3 has been ineffective in driving growth, what can governments do? Well, Japan has taken interest rates into negative territory, and there's Mr. Carney in the UK said he doesn't like negative rates, but it doesn't mean that he won't do it, because I'm sure he doesn't like rates where they are now. There are other things that they can do. They can actually just literally start to print money to fund things like HS2 in the UK. That would be direct monetization, directly piling money into the economy. They could try fiscal stimulus again through issuing infrastructure bonds, or they can try potentially things like further tax cuts. They can try things like, and the things that I would favour on a fiscal basis would be things like tax credits for R&D and employment of apprentices or employment of trainees. Because if you look, one of the big problems we've got in the world today is a productivity problem. And there's lots of exciting R&D going on out there, but it doesn't seem to be coming into anything like, say, the PC that I'm looking at right now, which the 1990s saved accountants having to use pocket calculators and abacuses to work out inventories. It could all be done on a spreadsheet, and then you had ERP software and goodness knows what else. That's productivity writ large. I love things like mobile phones, but looking at the number of people start gulping at Katy Perry videos on Twitter, on the internet, on the train, much as I like Katy Perry and I like Twitter, by the way, that's not a productivity tool. That's actually having a negative effect on people's productivity because they're sat there gulping at Katy Perry. So I think in that respect, R&D credits, tax credits for investment, for me, is a big step forward. Let's see what Chancellor Hammond comes up with in November and March. What's happening to Lloyd's shares? Is it time to sell even at 8? Okay, well, the government is underwater. Its in price is 73p. I think the share price, as I know today, is probably about the 60p range. And if the bank can keep its nose clean, not get embroiled in any more PPI, and it's not getting involved in any of the things that Deutsche Bank's currently wrestling with, like mortgage-backed securities in the US, and if the UK economy just jogs along and there's no housing crash, Lloyd's should be a very, very profitable bank. It makes £6 to £8 billion a year before nasties like bad loan provisions, PPI provisions, etc. If it keeps its nose clean, if the UK economy hangs tough, and I admit the latter one is probably as big an if as the former, profitable bank, generate lots of cash, pay lots of very tasty dividends. At 50 odd p, 60p, that is potentially very, very exciting for a long-term patient investor. If the UK economy does drop in a hole, Lloyd's is not going to get, none of us are going to get back to the situation we were in '07, but the shares would definitely suffer. And so I think again, you've got to take a good long look at where you think the UK housing market and the UK economy are going, because in the short term they will drive the sentiments, the bank's profits and sentiment towards it. Long run, it's about Lloyd's keeping its nose clean, running a tighter ship, keeping loan loss provisions under control, and paying out dividends. And if you think it's capable of paying a dividend of 5, 6, or 10p in the next 3, 4 years, you may well be inclined to cling on to it. Don't forget, Lloyd's dividend per share peaked at 34p a share. I mean, on a 60p share price, okay, that's not going to happen in a great hurry, but it shows you what potential there is in the bank if it does turn itself into a cash machine. Is there a good time of day or year to rebalance? I just did it the cockroach. I did it automatically on the 1st of January, just again, so there was a discipline there. If you're trying to be clever about it, you could say that to try and maximize your equity performance, maybe you would do it at the end of April because of the old sell in May statistic. And historically, the bulk of equity returns have been achieved between September and April, but that's history. It's no guide for the future. And when Mark Twain wrote that very, very famous droll comment about September being the most dangerous month to invest in, which I think statistically it is. But he then said other dangerous months to think about are January, February, March, April, May, June, July. And so in that respect, trying to get too cute on the timing, you're likely to tie yourself in knots. Again, it's probably best to keep it simple. Choose the date that's worked best for you, whether it's January for simplicity or whether it's around tax planning in April when you put your money into your ISA or your SIP, whatever, or your dealing account, whatever works best for you. Do it then, and do it simply and as cheaply as you possibly can. Can I please repeat my email address? Yes, I should. I'm happy to accept any emails that you may have. If you think of any, 54p. Thank you very much, sir, in terms of the Lloyd share price right now. Thank you. My email address is russ.mould@ajbell.co.uk. There you go. I think that's just come up on the screen. Now, do I have a view on gold over the next 12 months? Will cash become almost worthless after the now? Gold, I must admit, predicting any commodity over the next 12 months is a mug's game. Again, you'd be inclined to think that if central banks keep printing and fiscal stimulus comes, that it would go up. But equally, if the Federal Reserve raises interest rates, gold could come under pressure. I personally think the Fed will raise incredibly slowly, if at all. So, given that I think fiscal stimulus is coming, gold you would think has got potential, but you could have said that 2 years ago, and it's still lower now than it was then. So again, you've got to be very, very patient. But I think in an inflationary scenario, you'd expect gold to do well. If the economy starts buzzing and central banks raise interest rates, gold will probably have another period in the doldrums. Will I think money will be worthless? No, but I'm intrigued by central bank theorists and economists and people like Larry Summers in the US talking about, and Kenneth Rogo, the Harvard economist, talking about abolishing cash and just using electronic money. I'm not a rampant libertarian by any stretch of imagination, but I view that as a profoundly negative development and a potential tool of financial repression. Yes, the economists will argue that they'll do it because criminals use cash. But as we've just seen constantly this year, criminals use the internet as well. So you're not talking about banning the internet now, are you? Or cars because criminals use them as getaway cars. So that's a nonsense of an argument. What they're actually saying is we don't want people to use cash because if we move interest rates to negative, they can take cash out of the bank and shove it under the bed. Whereas if there's no cash, they can't. And that's why they're talking about it. And I think it's pernicious. Any more views on the American election? Great question. Um, Again, politics, long run, I think you've got to be careful of overestimating the negative impact. Short run, Trump and Clinton have begun to flesh out their policies. We know that Trump is anti-global trade. We know that Hillary is wobbling, but is in theory pro-free trade. We know that Trump is talking about building a dirty Great Wall, and he's actually talking about tax cuts and big spending at the same time. So you can only assume he'd blow the US deficit up completely. But clearly his idea is the tax cuts will stimulate the economy. We know that Hillary's in favor of more tax. We know that he's in theory of a little bit of moderate spend. We know that Hillary is very concerned about drug pricing. And if you're a biotech stock, you're probably looking slightly nervously over your shoulders at the minute. Equally, Trump just wants to rip up the Affordable Care Act full stop, which has got all sorts of ramifications. But at the moment, there's not, I would say, an awful lot of policy flesh on the bones. We've still got two more debates coming up. What I would say is, it normally, and if you look at all of the elections since 1945, when a Democrat wins in the first year, the S&P 500 has on average gone up, and in a Republican on average in the first year, the S&P 500 has tended to go down. I guess because Republicans are seen as a bit more high shirt and fiscally austere. Now, clearly, Trump is not a normal Republican. And equally, Paul Ryan, the Republican Speaker in the House of Representatives, can't stand the smell of him. So one thing that we've also got to bear in mind is we mustn't just look at the presidential result. We've got to look at who controls the House of Representatives and the Senate. Because that bicameral arrangement means there are checks and balances in place. So even if Trump wins, he's not guaranteed to be able to do everything he wants to. Obama's not achieved much in his second term because he's been blocked by an increasingly awkward Republican-dominated Capitol Hill. Hillary Clinton, and for that matter, Trump, may find themselves in the same situation. So it's hard to be dogmatic on what it means. But I think if you look at history, generally, Democrats are seen as a bit freer and easier with the spending and the fiscal stimulus. That's why the market tends to go up under them, the opposite for the Republicans. But it's hard to be quite so dogmatic this time because Trump is by no means a normal Republican. Deutsche Bank. What's my feeling on Deutsche Bank? It's a great question. I mean, Dominic O'Connell on Radio 4 did a really good piece on it this morning. And as he correctly pointed out on the Today program, the hedge fund withdrawal of collateral, they're potentially playing the game at both ends here because the hedge funds could be short Deutsche Bank stock and therefore actually aggravating the situation for their own personal benefit. Equally, Deutsche Bank is trading at a 33-year low. So Mr. Market is telling you it's not happy with what it sees. The International Monetary Fund has called Deutsche Bank the most systemically important bank in the world because of its colossal derivatives book, which I think the last time I looked was about 556 billion US dollars. Now, where that leads, I don't know. All I can say to you there is, I'm a trained financial analyst. I've looked at the financial markets for 25 years. I look at Deutsche Bank's balance sheet and don't know where to start when I'm looking at it. And I then just have a simple rule. If I don't invest it, I don't touch it. Now, that doesn't mean to say I won't miss a big profit. The shares could rally very quickly. Doesn't mean to say, though, but it might mean I certainly won't feel stupid if I avoid a big loss because, a lot of the best investors spend more of their time avoiding disasters than they do picking winners. And certainly with your portfolios where you may be selecting your own stocks or funds, avoiding the turkeys is perhaps even more important than picking the winners. Because if you buy a stock on you and it goes to zero and it was 4% of your portfolio, that's a massive hit. You now need to stock that's capable of doubling to make up the shortfall, and they don't grow on trees. So all I would say with Deutsche is, I think for the minute, it tells you that there are doubts hovering over the strength of the European economy. There are doubts hovering over the efficacy of the European banking stress tests, which I think were a bit of a joke. And I think it tells you with banks, they're incredibly complex instruments, and you've really got to know what you're doing if you're buying individual bank stocks. And a lot of fund managers, what I would say is, are underweight them at the minute. Now that means that if banks turn round, they'll go up like rockets. But I think at the minute, playing safe is probably the best option, given that the American banks, I think, are financially much sounder. They took a lot more pain in 08. Europe has dragged its feet. I think that's one of the reasons why the European economy is underperforming the US one at the moment. Has Japan also tried fiscal stimulus unsuccessfully? Yes, very good knowledge. I think this is Japan's QE14. They've tried negative interest rates or zero interest rates for 20 years, low currency for long. They've gone through multiple fiscal stimulus packages, and you're correct, it has not worked either. That is why Japan is in the fiscal mess it's in now. What you can say that it's different in the West from Japan is our demographics are better for now. We probably acted more quickly. We've got less sclerotic politics, at least for the moment. But you're correct. Even fiscal stimulus is by no means a certain solution to the current low growth environment. And what the world does not wish to do is turn Japanese. Even just for the narrow prism of investment, the Japanese Nikkei index peaked at 39,000 in 1989 and it's at barely 16, 17,000 today. None of us want to go down that path. And let's hope we don't, or it's going to be a pretty tricky next 10 or 20 years. Housing market. Well, I could talk about lots of different housing markets. If you look at the Bank of International Settlements latest report, it's incredibly worried about the Aussie housing market. Incredibly worried about Canada, particularly Vancouver. Vancouver, housing transaction volumes are going down and housing prices are still going up. That makes no sense at all. In the UK, yes, you've got to be worried because the builders are doing their best to crank up supply, but as fast as they do that, the government, the Bank of England, come up with tools that crank up demand. Buy to let, lifetime ISA. Now, to be fair, they're starting to cool that. We've obviously seen ex-Chancellor Osborne jack up stamp duty on buy to let and second homes. The Bank of England, through the Prudential Regulatory Authority yesterday, added an extra layer onto that by insisting that that banks do a stress test so that a buy to let buyer can pay the mortgage if interest rates go to 5.5%. And let's face it, I don't think any of us think they're going there in any great hurry. And there's a new interest cover ratio introduced. So in that respect, that will, I think, take some of the spice out of it. Equally, at the very high end, we've seen things cool in a post-referendum world, pre-Brexit world. But if you have got money and you're a non-British person and you're looking to park money in assets in a country where there is rule of law, an independent central bank, you're generally left to yourself so long as you pay your tax. The UK is not a bad place to be. And with sterling having just gone through the floorboards, that's the sort of thing that might potentially attract the odd buyer over the fullness of time. So I wouldn't want to be too bearish on the UK housing market because of that. Equally, prices can only go so far. People can only afford so much on their mortgage and their interest payments and their rent because they need to buy important things like food, lavatory paper, life's essential. So housing prices can only go so far as a percentage of people's income. And once you're into the mid 30s, you're kind of getting there. So uh, it would be unwise of me to predict a big collapse or a big boom because I just don't know. But I think ultimately there's a price for anything, and the UK housing market is probably closer to it than it is further away from it right now. So I wouldn't want to. Mortgage approvals are slowing down. The good news is the house builders have got fabulously strong balance sheets. They've got special dividend programs. They could stop buying land and run those special dividend programs quite happily. But what I suspect they would do is actually stop the special dividend programs and buy land on the cheap if it goes down again, because that's where they make their money. So I wouldn't want to rely implicitly on those very high yields from the house builders right now. They'd pay you a decent yield, but I suspect net they'd rather buy land when they can when it's cheap, and the dividends will come afterwards. Are emerging markets more predictable or relatively? And I think, to be fair, that's why they've actually come back into vogue this year after 3 or 4 years of underperformance. Now, I wouldn't want to say that emerging markets are predictable. Again, I never like over egging politics because investment is about valuation and that's driven by cash flow and profit. But you've had the impeachment of a Brazilian president. You've got India and Pakistan at each other's throats. You've got saber rattling in the South China Sea. You've got North Korea and South Korea on a nuclear alert. You've got Vladimir Putin still making nuisance of himself in Eastern Europe. So to say that emerging markets are more stable, well, maybe that doesn't say much for the West right now politically. But emerging markets are at least used to this kind of stuff. Yes, you've got multiple African countries going to the IMF for handouts because the oil price has collapsed. But I think what you can say with emerging markets is they've been dogs for 5 years. Lots of currencies have gone through the floorboards, and certain currencies on a purchasing parity basis, like the ruble, like the Indonesian rupiah, the Malaysian ringgit, potentially. Fund managers are going around saying they think those currencies look cheap. Now, as an emerging markets fund manager, yes, you obviously look at the individual company issuing the bond or the equity. But if you're buying a cheap currency, you've got 2/3 of the battle already. Because if that goes up, that's gravy for you. So I think the fact that you've got a lot of depressed currencies is a starting point. Emerging markets aren't cheap relative to their own history. They're kind of in the middle of their historic range, but they're cheaper than developed markets. And again, that's where they've come back into favor. The Fed hasn't raised rates, so that's backed the dollar off, and commodity prices have rallied, which is a good mix for emerging markets. If those start to unwind, dollar up, Fed rates up, commodity prices down, that makes it tricky for emerging markets, but at least you've got a little bit of valuation protection on the downside. Do I expect tax rises? In the UK, yes. Well, tax rises is maybe the not wrong word, but I think Chancellor Osborne's theory of taking corporate tax rates down to 15%, I think will get the bullet. I think if Hillary Clinton gets in the US, there will be tax rises. France, it's going to be interesting, very high tax rates there already. Italy, Renzi is talking about cutting income tax, but VAT and asset tax, but now in 2018, not 2017. Japan has put off tax rises from 2017 to 2018. It depends on the country, but net, just thinking of the Apple tax situation, corporate profits are at an all-time high as a percentage of GDP. The public is understandably fed up of austerity. There's understandable pressure for increases in minimum wages. I think that net, corporation tax certainly isn't going down. Politically, it's an easy win to go around closing some of those loopholes. I therefore think that corporations are potentially a target, and that's something that anybody needs to factor in when they're looking at corporate valuations and corporate profits going forwards. I think that's 45 minutes, fast and furious. I'm sorry I spoke so quickly. I was trying to answer as many of your questions as I can. If you have a specific question that hasn't been answered, you've got my email. If you want the presentations, you've got my email. You can follow me on Twitter. You can follow my weekly videos and weekly articles on the AJ Bell You Invest website. And I greatly appreciate your time today. I hope you all have a very enjoyable weekend and a successful and prosperous end to this year and a start to next year as well. So thank you for your time, and I look forward to staying in touch.